This is Taking Stock on Bloomberg. I'm Pimm Fox. According to Goldman Sachs chief global economist Jim O'Neill, only 3 of 600 people he spoke to recently predicted the currency would strengthen. And that's why he says it may be a sign that the euro is about to rally. Yes, rally. But take a listen to what my next guest said on Bloomberg just last week.
Parity, yeah, I think it's in the cards. Our forecast looks for parity at about 2 to 3 year time frame. Our nearer term forecast, I think that 125 is an achievable target, perhaps even within this week.
Michael Woolfolk is the managing director and partner at the Bank of New York Mellon. He's our guest now, along with Bloomberg Businessweek reporter Roben Farzad. Michael, good to have you with us.
Yes,
events overtook you. I mean, who could have predicted this, right? I mean, you got the direction right, but I mean, time frames, they all seem to be collapsing.
Yes, well, one of the things that you can't anticipate is market sentiment. And when you have speculators involved in the market and sentiment becomes unidirectional, you can have very, very rapid moves in foreign exchange, and that's what we saw over the past week.
And do you think that's going to continue? I mean, are we headed for further declines in the euro?
Well, I think Jim O'Neill probably has the right instincts. If the market is all one direction, you're fairly guaranteed to have at least a modest correction before too long. I remember over the last 16 years, maybe 1 or 2 instances where you had a run of more than, let's say, 10 days in a row. So, yeah, I'd say maybe a pullback to 125 is or even maybe 128 is probably in the cards. But if you go out 3 months, 6 months, 12 months, even 2 years, the euro has one direction to go, Pimm, and that's lower.
And is that because the austerity programs are going to really have to bite in the eurozone in order for all of this money to actually be well spent?
I think that's part of it. But this is more a multi-factor outlook. And you'll see kind of the stars aligning here with initially negative expectations about Europe and the sovereign debt issue benefiting the dollar in terms of a safe haven play. I think that later in this year, it's become pretty apparent that the euro is going to suffer in terms of GDP growth from these austerity measures. Consequently, the U.S. Growth differentials will attract foreign capital. As a result of the U.S. growing at 3 to 4% this year and next year, we think that the dollar will have a fundamental basis to strengthen. Next year, the Fed tightens interest rates, the ECB doesn't. As a result, you have yet another factor that spills over into dollar strength. So it's really a compounding issue with a 110, our objective really in a year and a half, the end of 2011, and parity pretty much guaranteed in a 2 to 3 year time frame.
Parity, 2 to 3 year time frame.
Yes.
And is that something that's going to be sustainable? I mean, is that going to ever change, or is that just going to be there for a while and we get to parity? We just have to live with it for a couple of years?
That's a very good question. What we've seen since the launch of the euro in January '99, and even if you stretch that back to the synthetic euro, back to January 1980, has been a very long cyclical move in these two currencies. So what you're likely to see is the dollar strengthening even beyond parity. We may see 0.85 in the euro-dollar rate before you see the recession in the U.S., a recovery in the Europe out 4 or 5 years, turning us back the other direction.
Roben, you noted what Michael was saying about interest rates in the United States, the possibility that Ben Bernanke, the Federal Reserve, raising rates here. Sure. What's that going to do to the housing market?
Oh, forget the housing market. I'm worried about manufacturers here. I mean, where do we want this exchange rate to be? I mean, we cry bloody murder when it breaks $1.40 or the 1.4 exchange. I mean, we're now terrified of the specter of 110 or parity. I mean, what is the sweet spot for this economy that badly, here in the United States, wants to wean itself from being kind of binge consumption driven to more export driven? I mean, is there a comfort zone?
Yeah, I think this is something that policymakers have asked themselves generation after generation. Ideally, you would want to maybe fix your currency, get rid of all foreign exchange volatility, and have it at a competitive rate, and then worry about monetary policy, other factors. But that's not reality, and it's very expensive, and there are unintended consequences of trying to fix your exchange rate. Probably, in terms of the sweet spot, the real effective exchange rate, comes in right about the same place the euro was launched, and right about the same place also corresponds with the average for the euro dollar since January 1980. Again, we're talking about the synthetic euro before January 99, and that is 1.17. The euro dollar's average roughly just below that 1.15 since January 1980. I think that's probably the sweet spot, and it begins to bite in terms of exporting when the currency gets much stronger than 1.1.